Did you know that 90% of options traders lose money? And that number jumps to 95% for traders with small accounts under $2,000? If you're trading options with $500 to $2,000, you're literally one mistake away from blowing up your entire account. Here's what's happening. Most small account traders think they need to take huge risks to make big returns. They see someone make 300% on a single trade and think, that could be me. But here's the brutal truth. Small accounts are highly vulnerable to large losses, meaning just one bad trade can wipe you out completely. The problem isn't your account size. It's that you're making the same mistakes as traders with $100,000 accounts, but you don't have the cushion to survive them. When a trader with $50,000 loses $1,000, that's 2%. When you lose $1,000 on a $1 500 account, game over. Most traders jump in, thinking options are a get-rich-quick scheme, without understanding position sizing, risk management, or having any rules-based strategy. They're essentially gambling, not trading. Let me break down the 5 fatal mistakes and how to fix each one. Mistake number 1, risking too much per trade. Never risk more than 2% of your account on a single trade. With a $1,000 account, that's $20 maximum. Most small traders risk 10 to 20% per trade because they want quick results. But that's exactly why they fail. Mistake number 2, buying expensive options. Stop buying $5 plus options contracts. Focus on cheaper stocks like NIO, AMD, or Snap, where you can get contracts for 50 cents to $2. This lets you follow proper position sizing without burning through your capital. Mistake number 3, not using stop losses. Set a 15 to 20% stop loss on every trade. If you buy a contract for $1, sell at 80 cents. No exceptions. The biggest account killer? Holding, losing trades, hoping they'll come back. Mistake number 4, playing earnings and high IV events. Small accounts can't survive IV crush. Stick to simple directional plays on liquid stocks. Leave the earnings plays for when you have more capital to weather the volatility. Mistake number 5, wrong broker for small accounts. You need commission-free options trading. Paying 65 cents per contract when you're only trading 1 to 2 contracts kills your profits. Use Webull, Robinhood, or First Trade. They offer $0 commission options trading. Position sizing formula for small accounts. Account size times 2% divided by contract price equals maximum contracts. Example, $1,000 times 2% equals $20. Divided by $1 contract equals 2 contracts maximum. An example will look like this. With a $1,000 account following our rules, looking at AMD trading at $140, the $142 call expiring Friday costs 80 cents using our 2% rule. $1,000 times 2% equals $20 maximum risk. $20 divided by 80 cents equals 25 contracts maximum. But wait. That's still too risky because options can go to 0. Better approach. Buy 10 contracts for $800. Set stop loss at 64 cents, 20% down, and take profit at $1.20, 50% up. This gives you a 2.5, reward to risk ratio. Even if you're only right 40% of the time, you'll be profitable long term. The key is consistency. Small winners add up. Going from $1,000 to $1, 100 is a 10% gain. Do that consistently, and compound growth takes over. Remember, small accounts aren't about hitting home runs. They're about staying in the game long enough for compound growth to work. Follow the 2% rule, use stop losses, trade liquid options under $2, and use commission-free brokers. Your goal isn't to turn $500 into $50,000 in a month. It's to turn $500 into $1,000, then $2,000, then keep building. Slow and steady wins with small accounts. If this saved you from blowing up your account, smash that like button and subscribe for more small account strategies. Drop your account size in the comments. I read every single one. See you in the next video.